Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course, help to make it actionable, understandable, and clear. What a week, and therefore, what a show. Here we go. We're going to be looking at Mr. Morgan Housel's quotes. Can't get enough of those. A Wall Street Journal article about the Ivy League's failings. I understand you probably heard me. That's a drum I beat quite a bit. Mr. Jason Zweig, one of our favorites. An article about margin debt. What that looks like, how it's actionable or not, and what we can learn from it. So let's start off at the top. Mr. Morgan Housel. Now, if you're a regular listener of this podcast, which I certainly hope you are, you'll remember Morgan Housel was the author of The Psychology of Money. But more than that, he is in many ways an excellent thought leader in the entire personal finance space. So he has a email that he'll regularly send out. This week's came with some excellent quotes. So I want you to listen to these. We'll give a little commentary. These are ideas from Morgan. First quote, you don't have to know exactly what the future holds to know that some people will handle it better than others. Now, if we were to translate that into investing knowledge, to the prepared will the spoils go. So whatever financial calamity comes in the future, we don't know, but some people will handle it better than others. People that aren't borrowing a bunch of money, people with cash reserves, they're going to handle it better than others. Quote number 2, the most valuable personal finance asset is not needing to impress anyone. Now that may not be news to you, but for those that embrace wholeheartedly the moniker of keeping your cost low, investing simple, and time horizon long, you know you have to live this every day. Because you know what does not impress people? Simplicity. Rarely has. And then we'll close with this quote from Mr. Housel. The proper financial mindset is to be scared enough to save for the short run and brave enough to invest for the long run. Did you catch that dichotomy? You got to be a little scared to save in the short run because you don't know what's coming next, but you've got to be optimistic. You've got to believe. This is one of Warren Buffett's secret sauces. He's got this wild-eyed optimism about the future, and yet he's got, right now, I forget the number, $250 or $300 billion in cash in the short run. Very rare to hold both of those ideas simultaneous. I agree with Mr. Housel. Really important. The application there is just have long-term investments. We like our low-cost index funds, but don't go overboard. Be sure you have adequate cash for the storms, and don't borrow against the stocks unless you really have to. We'll talk about that more later. This was a doozy. Mr. Jason Zweig, he's back. As you know, Jason Zweig makes it onto this show quite a bit because he's great at what he does. Headline for him, the Ivy League keeps failing this basic investing test. Elite universities are again stuck with illiquid assets just when they badly need cash. Now let's define what an elite university is and isn't. I'm just going to go down the list of what's a good university and what's a bad one. Just kidding, guys. Just not going to do that. The article does it for me. I don't have to offend anybody. Wouldn't you know it, Mr. Zweig talks about the Ivy League as a premier group of universities. I see no mention of our beloved Texas A&M. That's just fine. I actually think Texas A&M invests just the same as everybody else, so it doesn't really matter. He says this, why does the smart money keep flunking investing 101? I love the way he says things with such clarity. During the 08-09 global financial crisis, many of the world's biggest investors found themselves in dire need of cash because they had sunk too much money into assets that couldn't be publicly traded. He goes on, now they've made the same mistake all over again. So check this out. Over the past couple decades, he writes, no group of investors has piled into what are called alternative assets more eagerly than the endowment funds of major colleges and universities. What were they doing? Get this. They were seeking to emulate the stellar success of Yale and University endowments David Swensen, who passed away sadly in 2021. So it was the Yale model, and everybody and their brother decided, you know what? We like what Swensen did for Yale. I think he took them from $1 billion to 25 or something over a number of years, and did so. He used private equity, venture capital, hedge funds. Well, what happens when you do that? You lose what's called liquidity. So Zweig highlights, the results whenever you roll into these hedge funds, which are just private vehicles that will own various securities, private equity, again, not traded throughout the day, venture capital. These are lockup type investments, typically with high fees, a lot of complexity. So the results don't look like the 60% stocks, 40% bonds that historically have been a guidepost for both these institutions, but also individuals. So get this is surprising. On average, in fiscal 2024, educational endowments with more than $5 billion in assets held only 2% in cash, 6% in bonds, 8% in U.S. stocks, and 16% in international stocks. This is according to the National Association of College and University Business Officers. So that means 2/3 of their holdings are in private funds, non-traditional assets. Well, what's been happening lately? Panic. Mr. Zweig highlights there's absolute panic in some of these institutions. I'll name them. Brown, Columbia, Cornell, ever heard of it, Harvard, Northwestern, and other universities. Because guess what happened? The Trump administration threatened to cut off their federal funding. So even though they've got billions and billions of dollars, doesn't matter. Not liquid. This is what you'd call a surprise. How, as Dave Ramsey reminds us, how's their emergency fund? Let's take Brown University. Their endowment assets exceed $7.2 billion. They had to borrow $300 million in April and an additional $500 million in July. And now they don't tell me. I wonder at what rate that was. Probably not great. Rates are not great. Northwestern. It has a $14.3 billion endowment. $14.3 billion. It borrowed $500 million. And Harvard, it's got a $53.2 billion endowment. I'll say that again. Harvard, $53.2 billion. This is one institution. It had to raise, it didn't say borrow, but raised $750 million in April. So Zweig helps us understand sometimes endowment monies are restricted by the donor, there are specific purposes. All the more reason why it was so dangerous for these folks to go into these complex, high-fee, non-liquid assets. So Zweig goes back. Do you remember 2009? Zweig does. Zweig says that it's deja vu. He says there's a survey of college and university presidents. 50% have or will put in a hiring freeze. He wrote in 2009, 7% admitted. These are the ones that admitted it. Selling assets in a bear market. 9% have been forced to borrow money at punitive rates. These are big dogs doing this at punitive rates. So even these complex, well-staffed, large asset-based institutions without liquidity, they're making poor choices. They have a sudden need for cash. They don't know what they're doing. And here we go. How are you going to sell your assets? Well, it ain't easy. It ain't easy. Selling these illiquid, non-traded assets means you're probably not going to get a great price. Buyers are going to demand a discount. And it's going to be difficult. When you're in the stock market or the bond market, you click a button, you're liquid, boom, you're done. It's a fair market. Typically a lot of action. This spring, get this, the article explains, after months of effort, Harvard sold $1 billion in private equity funds at a 7% discount to their stated value. Very difficult for them to do. Yale, which of course started all this with Swinson, they are seeking to sell right now several billion dollars in private equity funds. They've been trying for a year. They say the funds are expected to sell for less than their stated value. These are the marks that they're being given internally and by the fund. So various studies have been done to show, well, hey, what are the risks here? Well, there's a gentleman that gave a bunch. They said Lawrence Siegel, who's the research director for the Ford Foundation's endowment, he analyzed what would happen if these institutional investors that had gorged on alternative assets, the article explains, suddenly needed to raise cash. This is 2007. This is right before it happened. He warned He warned that an institution with 50% of its assets and alternatives can run out of cash in as little as a year or two. No one listened to him. And of course, what's the rest of the story? 2009 hits, and within months, some of these folks suffered their worst losses since 1970, and they turned those paper losses into real ones because they had to sell their most liquid assets in a market panic because they had no money. So you've heard me give warnings on private equity style investments and lockups. These are folks with a lot of liquidity. Now, this is usually what the pushback I get, understandably so. I'll hear this, but Robert, David Swinson, this is Swinson at Yale, achieved wonderful results when he took over to when he left, and the endowment increased in a phenomenal pace. To be sure, let me quote Swinson for you. This is Swinson. He says this: when you look at the results on an after-fee, after-tax basis over reasonably long periods of time, there's almost no chance that you end up beating the index fund. David Swinson, Chief Investment Officer, Yale University, when he gave the quote. So this is Swinson. He's behind the curtain. He sees it all. And he's saying, it looks like over long periods of time, and no one's going to beat the index fund. No one. We do well to heed his advice. And then our Wall Street Journal article, we have a record margin debt. What does that tell us about today's stock market? We'll do a little definitional work. What's margin debt? It's when you borrow, so you're borrowing money, incurring a debt, and you have collateral for that debt, which are stocks or bonds. It's liquid securities at a brokerage house, typically, at a Interactive Brokers or Charles Schwab, or now you can do it just about anywhere, Vanguard, Fidelity, higher rates, but that's what it does. That's what it is. You're borrowing money on stocks. Now, a little walk down memory lane. The late 1920s, I don't think I have any listeners that were investing in them. In the late 1920s, purchasing stocks on margin was the craze, and people did it all the time. Of course, when the stock market dropped from 1929 to 1932, the wipeouts, there was a top to bottom drop of 90%. So people got absolutely wiped out. That may have been the wildest, most ubiquitous time for margin investing. I don't know that. It'd be worth looking up. But here's today's article by Teles Demos. Not today's, this week's article. More investors are using borrowed money to buy shares. But this isn't necessarily a signal at the top. And what this article goes in to show is that there are various reasons for why these margin debts are as high as they are. It's at an all-time high as of July. It topped $1 trillion with a T for the first time. FINRA is who tracks this, and they get the data from all the brokerages. So sometime, when I first read something like that, I think, is this the late 1920s? Is this the prelude to what occurred back then? And we know what happened after that. It took you from, if you did a one-time lump sum investment in 1929 at the peak, you didn't get back to even till 1954. That's a lifetime in investing. So that was rough. That was rough. And a whole generation swore off owning equities at all. But in this article, it says, here we go. Here we go. All-time high. Does that mean that we're just as toppy can be? How many times can you call in a top on the stock market? As many as you want. So this article explains, well, not always the case. If you borrow shares, try to short sale the market, as the market rises, wouldn't you know it, your margin debt can increase. So believe it or else, the way this can work is the market goes up. You short sold, so you've got to post more collateral. You got to post more and more. You're borrowing more. And you've got a margin loan that grows. So stock prices rise, margin debt can become mechanically bigger. So, all right, well, that's not as helpful a tool. So that was interesting. I kind of read this. I thought, that's great because, me, I always think the stock market's overpriced. Try never to act on it, ever, ever, ever. But my instincts are poor, and I always think, oh, certainly this is the top. This is ridiculous. How in the world could someone? Oh, here we go. Keeps going. So this article talks about how the margin loan books at all these Charles Schwab, Interactive Brokers, it's great for great for those stocks, and they've done really well. I want to talk about the individual investor when they elect to use margin to invest. Of course, it's permissible, of course, and believe it or else, Interactive Brokers, in my experience, has the lowest rates in this regard, maybe 5.8% today. You'll have to double check me on that, but it's typically one of the best rates in Interactive Brokers, and within limits, like anything, like alcohol, like driving a car. As long as you go the speed limit, you're fine. As long as you have a drink or two, you're fine. But what margin debt does is it brings the liquor bottles into the cabinet, and you may or may not be able to handle it. I'd add that a little margin debt affects everybody. What I'll stand my ground on is to say it doesn't matter how much you borrow. Let's say you borrow 10% of your portfolio on margin, 20%. No one's going to look at that, and you're not going to get what's called margin called, is when your assets dip so far below your initial price, your cost basis, that they have to ask you for more, or they sell your equities, they liquidate your stocks for you. That's kind of the worst case. But what it does, it increases the fragility that you have as an investor, because volatility hits, and all of a sudden, all of a sudden that margin feels like a burden. Feels like a really heavy burden. And I've not met, I don't care how stoic you are, I've not met the investor who's impervious to the weightiness of borrowing money when stocks are going down day after day after day. It makes you much less resilient. Doesn't mean you can't do it. I'd also add there are times when it's the preferred mode of borrowing. Hey, if the mortgage rates are rough, you don't want to go through a bank and give a quart of blood for whatever they want from you. You can click a button, borrow on margin, boom. Get the money in your account. The system's set up. Easy. It's a dangerous thing how easy it is, but easy. But what I've learned over the years, doing the work I do and meeting folks, when I meet someone in their 60s or 70s and they have a large net worth and a lot of it surrounds one or two assets, and I'll ask, what's the story? You know what they don't tell me? Oh, I just stole this asset 35, 40 years ago. I just bought it, bought it so cheap. Okay, so typically that's not it. And you know what else they don't say? Oh, over 40 years, I got the IRR, I got my return, I calculated it. It was like 16.75. Most of the time they don't even know. You know what I hear? I just kept it. It's not a complicated, kind of an elementary answer typically when I say, I just kept it. Everybody told me to sell it or whatever, and I just held on to it. They have no knowledge of what they paid at the time, whether that was a good or bad deal. No knowledge of what their rate of return was over 40 years. Just that, I just held on to this one. And wouldn't you know it, maybe they earned 6% a year or 7% a year, but over 40 years, it trounced all their hotshot investments. Because you know what they did? They kept their costs low, their investing simple, and their time horizon long, because that is what's going to give you the best shot on your investing journey. Until next week.